Good morning, everyone. Welcome. This is Joe Scarice, nationwide direct private lender, co-founder of the Clubhouse Creative Birth Strategies podcast, as well as the podcast itself, the Creative Birth Strategies podcast. I want to thank everybody for coming in. Happy New Year. We're gonna get everything set up this morning. We have another great discussion. We're going to be talking about mastering rental investing, finance, and growth strategies. I think it'll be a good discussion on scale, on capabilities going into 26. We'll get rocking and rolling here in just a few minutes. Invite some people in. Kind of an okay week. We'll get into the market itself. Very interesting. Obviously, we have some U.S. tensions down in Venezuela, so it's not going to really do much impact, I would say, to rates or circumstance right now. But it's definitely a domino effect of where that will all go to and how that will impact rates long term. But let me just get invite some people in here and get really started here in the next few minutes. Pretty excited about it. Yeah, we had a great week. Christmas, New Year's was quite eventful. You know, a lot of good festivities, and got to travel to Philadelphia, New York. You know, in the Brooklyn area. We were in Boston. We were in Providence, Rhode Island, and Hartford, Connecticut, and Boston. Really kind of went with a lot of the national cities. Met probably close to 600 or 700 people. It was quite really. Quite exciting about the whole thing. Just just meeting so many investors motivated to make a difference in their career going into 26. It was just really interesting to watch the excitement in the room. Just making everybody moderators here. Hold on one second. So, I'll get here in just a quick second. I'm inviting some people up here, get some moderators up here. Let's just try to get everybody up here. Why not? Get started here. Just a few minutes. Uh, this is broadcasted on 300 Facebook groups, LinkedIn, YouTube. Um, Pretty excited about where the podcast is going itself. We'll see where we land with Clubhouse in time. We have some plans. We just updated a lot of our social media equipment to do some rooftop marketing and networking at our space in Philadelphia. So we're gonna probably pivot around as of March 1st with Clubhouse. We might cut it down to a couple times a month and really focus on one-on-one discussions with different investors and a live audience in Philadelphia. So we'll see where that all goes over the next couple months. So we're just moving things around in a good way, getting some social media things updated. So let's dive into the market here. This a snapshot for this past week. Based on the latest week of this data, including rate movements and sales momentum and broader housing trends, mortgage rates kind of eased modestly by the end of 2025. We're probably somewhere around 6.15, 6.2 on the base rate of conventional financing. We're probably, we're hovering around 6.5 right now when it comes to, commercial lending, DSCR. I've been seeing 6.5 as a number, 6.75. It's been leveling off a little bit. Construction money, of course, has been easing. So we're seeing construction money going down to about 8.375, 8.5 as a base rate for the experienced borrower with at least 3 or 4 deals done in the last 3 years. Housing activity, of course, you're at the seasonal slowdown, but pending home sales ticked up a little bit. I guess a lot of people want to grab some tax opportunities before the end of the year. But it's been a very wishy-washy market. I've been watching the condo market specifically. It's starting to bottoming out a little bit in some markets. So I'd keep an eye on that. I think the condo market is a big indicator where your spring market's going to look like. Condo market's a little sluggish. Days on the market, pricing is coming down. People are taking properties off the market as well. Affordability remains obviously a central constraint. Hopefully some of the forecasts going into 26, we're looking at more balanced markets, modest home price stabilization, affordability improvements. What does this mean for the investor the lenders, the brokers, slightly lower rates. I'm not going to say they're going to drop heavily. Regional variations matter greatly. Some markets are greatly already moving toward balance in supply and demand faster than others. It's going to be very interesting to see where like the Northeast goes compared to the Midwest is very hot right now for investors. So it'll be interesting to watch where that migration goes for the out-of-state landlord. Refinance activity in the investor side, it's very heavy. On the consumer side, very light. So it'll be interesting to watch going as we get closer and closer to April-ish when the new Fed chair is most likely. We know who it is. And the past week's data shows modest relief in borrowing costs, increasing buyers' interest and beginnings of market bounce, but no sharp turnaround. Affordability pressures and regional disparities remain top themes as the industry kicks off 2026. So that's a little update to the mortgage industry space. Top market in the country right now, watching a lot of migration from Northeast and specifically from the West Coast is South Carolina. It's a major turning housing magnet. The whole Greenville area. Keep an eye on that market. A lot of people are liking it more so than North Carolina and some of the other East Coast shore point areas. So South Carolina is a hot spot right now. A lot of increases there. Seeing another interesting article, delistings surge as frustrated sellers retreat, hurting pandemic boom towns most. So we are seeing people taking properties off the market going into the fall or winter market because it just died. So very interesting article. I'll probably post that up post this room. And then one other article that caught my eye. Home prices are up a little bit in November, but more increases expected in 26. I don't know how comfortable I'm with that because I see market numbers coming down because I mean the longer a property's on the market, the better shot they're going to drop the price. So it'll be interesting to watch that indicator as well. So let's get into mastering rental investing, financing, growth strategies, right? So a modern framework for building and financing scalable, profitable rental portfolios is designed for today's rate environment and lender underwriting realities. The core pillars are smart acquisition, financing that scales, underwriting that wins. So, we have a white label underwriting course because we want people to be better underwriters, even if they're not going to have broker money. We want them to be a better real estate professional. And growth strategies like, is it BRRRR? Is it midterm rentals? Is it small balance multifamily? You got to be very strategic. And then you got to look at, who's managing out that property, who's your team of experts, right? So some things to think about, whether you're going to be that investor scaling from 1 to 10 doors to 50 over the next, say, 2 years. Okay. I mean, I see a lot of people not flipping as much and holding more because of the environment we're in. My flippers are holders now. They're becoming debt service coverage ratio experts. So, the playbook is shape shifting a little bit. Very hard to see what's going to happen by the end of second quarter because of the Fed. But, more than likely, we're going to see a surge in investor financing more so than consumer financing because consumers are going to hold back. The affordability is still just not there. From a rate perspective, from a concern of affordability perspective, economic jobs perspective, there's some uncertainty where the investor doesn't get caught up with a lot of that. They're hyper focusing on the opportunity of playing landlord for the disgruntled home buyer that couldn't afford to buy a home. So some interesting thoughts to start off with. And I do want to add one other thing that caught my eye was the top 20 small underrated rental investing markets that to consider going into 26. I'll quickly go through the top 20 that I put together based on some interesting numbers, affordability and yield, stable demand drivers, lower competition and entry barriers, and strategic growth versus cash flow balance. Number one is Tulsa, Oklahoma. Two is Dayton, Ohio. Cleveland, Ohio, number 3. Toledo, Ohio, number 4. Youngstown, Ohio, number 5. Flint, Michigan, number 6. Number 7, Gary, Indiana. Number 8, Newcastle, Indiana. Muncie, Indiana, number 9. Number 10, Birmingham, Alabama. Number 11, Kansas City, Missouri. Number 12, Corpus Christi, Texas. Number 13, Laredo, Texas. Number 14, Columbus, Ohio. Number 15, Indianapolis, Indiana. 16, Rochester, New York. 17, Providence, Rhode Island. Uh, 18, Richmond, Virginia. And 19 is Grand Rapids, Michigan. And ending off the top is Columbus, Georgia. So very interesting dynamics there to lead into our discussions and our moderators discussing mastering rental investing, finance, and growth. We'll start off with Mr. Brian Guth. Good morning. Welcome. Brief overview who you are, what you do, and thoughts to our discussion this morning on mastering rental investing.
Good morning, Joe. Good morning, friends. Let me be the last to wish you a Happy New Year. So my name is Brian Guth. I'm in the upstate New York market. I think it was you mentioned maybe number 16 as a Rochester, New York.
Yep.
So we do, my wife and I do fix and flips, fix and holds, Airbnbs. Mostly though, Airbnbs are midterm rentals. I'm in the Rochester market. I focus solely on this area. I agree with Joe's assessment as far as kind of the low entry barrier, the demand. Really, I'm heavily my main strategy over the past 3 years has been BRRRR, and that BRRRR, mixed with, again, the acquisition might be a little bit different, whether it's hard money, whether I get a handful of seller financing, regardless of how I'm acquiring it, then the exit strategy obviously is, get it, buy cheap. Again, you make money when you purchase, so get the good value, and then, obviously rehab it, rent it out, refinance, and go again. So my model, usually I try to be at, $400 to $500 per door. And in a situation where between obviously the acquisition, the holding costs, the refi costs, all that fun stuff, once all said and done, and I'm walking away, I get my, my check at the closing table when I refi it, I'm basically zero money into the property, or I've actually gained money at the closing table. Depending on the deal, I'm not opposed to having some money left in the deal, but obviously my preference is to have cash out and go to the next deal. So, what I use for my gap funds, because depending who's my lender, I don't have hundreds of thousands in the bank to do all these acquisitions. So I'm usually going through hard money, like I said, or possibly seller finance. If there's gap there, I use lines of credit. I know MB Capital is a great partner to assist with some additional funding, but basically use those lines of credit as the gap. Do the rehab. Wait for the reseasoning period, get it refied, and then put those funds back in the line of credit and go for the next one. So I'm able to scale quite quickly with that process. I know a lot of people talk about the BRRRR strategy, but it can definitely be done. I think that the biggest thing there, usually holding costs are pretty fixed. Rehab costs can be fixed, obviously, depending on, how large the rehab. I guess my point is you can predict those. So the biggest variable I see is obviously the acquisition cost. Depending what your method is to acquire, the old adage, when you're making an offer, you should feel a little bit uncomfortable making that offer. And if you are making an offer that you feel kind of comfortable making, you're probably offering too much. So you should always feel a little bit queasy when you offer that lowball offer. And if you're not feeling queasy, you're probably offering too much. So with that, I will pass it back.
Brian, you brought up a great point. One, I made an introduction to you to Jim, the guy that's interested in that 30 property deal. You might need some collaboration. I just did that because you remind me you're on here today. So two, it's funny you say that. I made an offer on 2 different condos down at the Jersey Shore, and I'm taking into account that I feel like the condo market is slumping down there. So I literally, one was 189. I put in 170. So I gave myself almost a full 20 grand consideration of depreciation on a property. And then one was asking 139. I went in at 120. I asked for $5,000 credit on either or, and because I'm covering I'm hedging my bets. I don't think it's going to bottom out to where the condos are going to be 80 grand, but I think I'm going to lose. It's like buying a boat. I think we're going to lose. You lose money a little bit the first day you buy these properties. So very interesting perspective that you brought this morning. And why isn't Buffalo or Albany on here? And Rochester is the question of the day, Brian, right?
Yeah, and I don't know if that's rhetorical or not. I really don't know. I don't know. It's very odd to me. Like obviously, so geographically, Rochester, we're nestled in between Buffalo and Syracuse. I mean, just from my knowledge, between a Buffalo, a Syracuse, a Rochester, we're all basically the same. I don't know why the kind of the difference in Rochester. Maybe because some of the larger universities. But I mean, Buffalo and Syracuse have them also, obviously. So I don't know. I'm not sure, but I'm not going to fight it.
Yeah, no, it's very interesting to watch that because Albany has been very hot quietly, and Buffalo as well. And but I'm not surprised with any of the Ohio's because the barrier of entry to get into the Ohio market is just. I mean, you got five, four, five. You got five cities in Ohio in the top 20. I'm surprised Oklahoma City's not in there. I am not surprised about Kansas City, Missouri. A little surprised about Providence, Rhode Island, to be honest with you. But I appreciate your insight this morning, Brian. So, little tidbit here. If you're a newer investor versus an experienced investor, you know, financing is everything. Understanding comps is everything. Your growth strategy is everything. I'm a big believer in lighter to medium rehabs than full gut to the studs because it allows you to keep moving forward a little quicker into the environment, right? Because you want to get these properties online, right? Of course. So you really want to look at how long is it going to take you to complete these projects to get them live, right? Because you still have days on the market in regards to getting the property rented up, right? You got to have some concerns here. And I went to, like I said, I went to five major cities this past week before New Year's Day. And the common denominator of the new investor is what do I do first? I'm trying to find my lane. Good morning, Bob. Welcome. Brief overview who you are, what you do, and thoughts to mastering rental investing, financing growth.
Hey, good morning, Joe. My name is Bob Chesisck. I'm president of Chesspin Corporation, helping people set up LLCs. I'm not a lawyer. Nothing I say is legal advice. And I think, I mean, I'm as you folks know, I'm personally not a real estate investor. So, although I did wind up with a property in my lap last year, which I'm learning learning a lot about home ownership from the trial by fire method. So it's been an interesting ride, but I do have one that I would say is Joe, and I'm going to kind of toss this at you. Shall we say, it came from the peanut gallery. I got a call from a prospective client this week, and it was kind of one of those doesn't really know where she's going kind of situations. So I figure I'll throw this out at you, and could be a good one for the audience to hear. Long story short, she has property. I guess there's property in her father's name, and it's rentals. It's out in the Williamsport, Pennsylvania area.
Okay.
For those who are unfamiliar, that's north central Pennsylvania. And I guess the father's in a debate about whether or not to take these rental properties and flip them into an LLC versus just keeping them in his name and adding her as a joint tenant with right of survivorship. They are income producing. The daughter basically does all the work. The father basically is like, yep, talk to my daughter, but it's caused all kinds of problems because his daughter's name's not on the properties. So I don't know if she's really looking to buy or acquire additional properties, but just kind of wanted to take it from the perspective of somebody who's about to become a unexpected investor in real estate. What you would think about that for, what you would, if that call had gone to you, what would you tell her to do? And from your perspective as a lender, and what would you suggest for her for future growth?
Well, I'm not an attorney and I'm no longer a CPA, so I don't want to act like I am on here. So that's my disclaimer. First thing. I know a lot of people try to play attorney and CPA on here, and which they shouldn't, but that's a whole nother discussion. But my thought to this, because you want to avoid the outcome, the end game, which is the dad eventually might pass, right? And now you're dealing with inheritable asset or assets. I would be transitioning these properties. One, I would season an LLC on all the properties, or yeah. And then what I would do is making sure the dad's still on that LLC with the daughter, right? But he would be like a minority interest since she's running shop, right? She would be really the majority interest. And as long as her credit is there and she's not looking to do some major cash out, but assemble the properties into into an LLC to protect her down the road, God forbid something happens with the dad, and it would be just a lot easier for her to sell off if need be at that time as well, avoiding a lot of the inheritable stuff that goes on as somebody passes. That'd probably be a smart move, is seizing the LLC on there, because after 3 months of the LLC being seasoned on there, any asset-based lender will refinance the current debt or a certain LTV based on her credit capability, meaning if she's a 660 credit or above. If her credit's even better, she can. I mean, listen, the sweet spot in Williamsport, because it's a cash flow play. You're not going to get major appreciation up there, right? It's just one of those towns that it's all about cash flow. So low LTV, 50-60%, as long as there's no debt on the property. Leave that money in reserves for the what ifs or upgrades, or maybe she does want to expand, maybe she doesn't. But at least she has those reserves for her father to live nicely, her to live okay. And if something happens to him, the transition is consummated, and she just takes his percentage off the LLC upon passing or something like that. That probably would be something highly suggestive, and it probably would not be that expensive because assuming that the dad's owned them for quite a while, maybe there's no debt, and the transfer fee of putting an LLC onto each property won't be that expensive or daunting. And then she could always recover that cost on the refinance 3 months, 4 months down the road. That's some thoughts to that scenario, Bob.
Thank you, Joe. Yeah, that's because it was one of those when they call. Sometimes when people call, they're asking me like what they should do with their properties and all that stuff. And of course, not being a lawyer or accountant, I can't give any legal advice. I can only tell you what the consequences are if you were to do it, but I can't make that final determination or whatever. And my only experience in that regard was when I took ownership of the property, it was passed to me as a joint tenants with right to survivorship. But now there's a discussion about potentially sending it over to like the property I'm referring to that I have out in the Scranton area. I may eventually wind up owning it outright. But it's one of those things. It's like I want to be helpful in this area, but at the same time I have to be careful not to cross that imaginary line. So It's just kind of the nature of it. But I appreciate your feedback on that. That's down the line as a referral.
And my final thought to that before we go to the next moderator, and thanks you, Bob. Finance is a strategy; it's not just a loan. And if she moves these properties into the LLC with her being majority owner, she could reset the tax depreciation on the properties for herself that her father probably already exhausted if he's owned them that long, and maybe take a 10-year or 15-year tax depreciation on the properties again under her LLC. So it could be something very interesting down the road for herself from a tax advantage perspective. Melissa, good morning and welcome. Brief overview who you are, what you do, and thoughts to mastering rental investing, financing, and growth.
Hey, good morning, Joe. How are you? How are you doing?
I am blessed. Traveling the Northeast in 27-degree weather was great for my sinuses, but we made it. We did Philly, we did Brooklyn, we did Boston, we did Providence, Rhode Island, we did Hartford, Connecticut, and we got back home in one piece.
Well, thank goodness. I like that. I also like that you're going to start doing a little less. Actually, that'll give you some time to do other things. I think that's a great idea.
Full plans.
A couple times a month.
Yeah, we're gonna do more one-on-ones.
Yeah.
And because we're gonna be able to go live with the one-on-ones as well. And I extend anybody that's listening in, if they would like a one-on-one podcast edited by us, we'll do that. That's no problem. That's no cost. It's just a great opportunity to align with real estate professionals throughout the country. And but we're just changing things up because I have other events and obligations coming up first quarter that I have to make sure my sanity is still there. You know what I mean?
Oh my goodness, overwhelmed. Yeah, that can kill you. I've had that this past year. Absolutely. And I loved your boat analogy because up here in Michigan, we do have boats and we always say bail out another 1,000.
Yeah.
So definitely,
Yeah.
you got to be careful with those. Hi, everybody. My name is Melissa King. I am the founder of Busy Bee Virtual Solutions. And now I get to push my Care Bee virtual fiduciaries because I passed the national certification exam as a guardian. So the conversation that you just had with Bob, you saw me, I was blowing up everybody's icons. I can help you before you take that chaos to court, as even in conservatorships. So for today, though, your rental investing, let's think about buying better properties or getting better financing. It totally matters. You have to know your numbers. Let me give you some talking points. Let's see here. If you can't answer which property is performing best or which loan is quietly killing your cash flow, you don't have a portfolio. I like this. You have a liability zoo. ChatGPT is so great, isn't it? Finance, this goes along with what you said too, Joe. Finance is not bookkeeping, it's decision support. Good bookkeeping tells you what happened. Good financial systems tell you what to do next. And this last one I like is growth breaks sloppy systems. Every new door multiplies your risk. If your back end is sloppy, you're not going to have wealth. So I just want you guys to think of that. Get your team together, get your numbers together. If you're trying to find your lane as a new investor, you're not going to be able to do it alone. You will absolutely get overwhelmed. I've been trying to do this. I shouldn't say try. I've been working on this for the last 3 years. It started with you, Joe, yes, in Clubhouse. I got a little lost last year. I don't want to talk about that. But my husband is on board with me now. He started his own business. We're both really looking forward to the next couple years and doing some real estate investing for our future with our self-directed IRAs.
That's good to hear, man. You got a lot going on here.
Yeah, that's what this is all about, isn't it? You know, you don't want to be complacent. We want to keep moving forward.
Well, rumor has it I might be making a special visit to the Midwest Real Estate Investor Conference this year.
What? I haven't bought my ticket yet. So if you're gonna go, that'll get me to go.
Yeah, I mean, I'm debating about it. You know what I mean? Well, you know, I was traumatized the last time I was there. I was there when it was like 10 below, and but now they're having it in April, so I feel a little better that I'm not going to freeze my tuchus off there. So
yeah, on a Monday and a Tuesday.
I know that's a weird. I'd probably come in on a Sunday or Saturday and spend the weekend, and yeah, that sounds like a much better operation. But I don't know how a Monday and Tuesday is going to fall in that.
Thinking, but you did just mention something that people could come in before the weekend, and a lot of us could get together before the even event, and we could make it a fabulous event because we already know each other, right, from Clubhouse.
Well, so you know what that's what I was. You and I are I'm gonna reach out to you because I'm thinking maybe holding a happy hour and tying it in with you there, either on the Saturday or the Sunday in a neighboring spot somewhere there that you can help me orchestrate. So keep that in the back of your mind. Let's talk about that in the next couple of weeks. So because I would only do it if I know that's going to be assembled. You know what I mean?
Absolutely.
Yeah.
Yes, I can totally work with you on that.
Excellent.
Game for something like that. That sounds like a lot of fun.
Excellent. Thank you, Melissa. And congratulations on everything. So, you brought up something that I'm going to tie into what you just said. Systems scale, hustle doesn't. Growth comes from property management alignment, expense discipline, rent optimization, capital stack planning, and repeatable underwriting. So I wanted to add some of those additional thoughts to what Melissa said. I would agree with her. Long-term winners think in portfolios, not properties. One property doesn't build wealth. A portfolio with intentional financing, diversification, and reserves does. Tina, good morning and welcome. Thank you for your patience. Brief overview, who you are, what you do, and thoughts to mastering rental investing, finance, and growth.
Well, thank you, Joseph, for inviting me. I am so grateful to be here and be in everybody's company. My name is Tina Crawford, and I am what we call a certified wealth educator. I am partnered with United Wealth Education. I am not a financial advisor, nor do I actually fix people's credit. What I do, I am a credit restoration referral specialist. The company that I am, excuse me, the company that I am aligned with, they actually fix people's credit. They are attorney specialists that I refer to. And the services that we actually provide, which makes us different from credit repair, we provide restoration services, including business funding, as well as provide three pillars, which is actually to help people build credit. We also provide services that protect the family and help people organize their finances through what we call a protection plan. So, and that's what makes us different in terms of credit repair versus credit restoration. We provide additional services through what we call a protection plan. And we actually teach people that our foundation is based on transparency and education. We don't lock people into a contract as if we're trying to hold them hostage, which a lot of credit repair agencies actually do, which is what makes us very different from other agencies. We actually pull from the the Fair Credit Reporting Act to actually help people understand how we do what we do when it comes to removing things from their credit report.
Okay.
And again, we provide additional services by helping them to budget, save, and then also pay off debt to get them in a better place and to make better decisions moving forward, because everybody's situation is different. But again, we also provide business funding up to $10 million, depending on people's situation. So even when it comes to housing and purchasing vehicles, because a lot of people go into these situations blindly.
Yep. So let's pivot to the
foundation is based on education. I'm sorry. Go ahead.
Let's pivot to the subject. I appreciate the overview because we have to hit all the other moderators. So when you get a chance, what's your thoughts on mastering rental investing and financing and growth?
Yes, again, it's based on education and mastering rental. Again, teaching people how to read their credit report and how your credit score is actually calculated based on 5 different entities, paying 35% paying your bills on time. 30% is based on your 35% is based on. I'm sorry, now I'm drawing a blank here. 30% is actually based on your credit limits and keeping everything under 30%, which we actually emphasize actually up to 10%, of course, based on your credit limits. And then other factors is maintaining I'm sorry, guys.
It's all right. It's your first time. Listen. So Tina, let me give you a little update how we do things. Like in our podcast here, we do a brief overview, right? And then you kind of tie into the subject of discussion. It's not a heavy sell to who we are. I think, obviously our profiles identify who we are. We're here just to give a kind of feedback to the discussion at hand. So in your experience, let's make it easier for you, Tina. So we get right to the heart of the matter here. So mastering rental investing, financing growth, what have you seen for investors going into 26 that you've been suggesting to make some moves for them in regards to, strategy of scaling or starting off, just some type of advisory that you've provided that, right off the top of your head, to an investor client of yours over the last week or two going into the new year, something that you've advised somebody on?
Basically, savings and getting their debt down.
Okay.
And we offer in terms of debt payoff, we actually offer what we call like a calculator to put their debts in, and it actually helps them to pay their debt down in 2 different ways. Where they don't actually need any additional income, and what they actually save in paying their debt down a little bit faster, that they use the savings from that to put in the savings calculator so they can actually earn the savings to use to invest in what they may want to invest in.
Excellent, Tina. I appreciate that. And I appreciate it. It's your first time up. I want you to get comfortable with it. So I appreciate you coming up. And I know you reached out to me via LinkedIn and now you've been attending our workshop. So we just try to give some insight and direction for our listeners because, post production, we're hitting 3,000 to 4,000 people on this discussion every week. So I appreciate you coming up and being part of this in the new year.
I appreciate you having me, Joseph. I really do.
Thank you, Tina. So we're going to keep moving this along. I mean, bottom line, rental investing mastery lives at the intersection of finance discipline, like what Tina was saying, market realism, and long-term vision. And our next moderator, we are collaborating on an event going into the new year in the Lehigh Valley market, Mr. David Bergio. I'm very excited about being part of Lehigh Valley again, on a consistent manner. We're going to be in Harrisburg every month, starting this week, coming up on the second Thursday. But Lehigh Valley's coming up next week. We're in North Jersey with Van Robinson and Joseph Hernandez. And we're in Philadelphia with Yardell Perkins of Perkatech. David, good morning. Brief overview, who you are, what you do, and thoughts to mastering rental investing, financing, and growth.
Good morning, Joe. Thanks for having me. Hello, everybody. Happy New Year. Man, I'm excited. I'm really glad you brought up the Lehigh Valley. I want to touch on that a little bit. But thank you all. My name is Dave Bergio. I'm one of the owners and founders of Trifecta Credit Solutions here in Allentown, Pennsylvania, where we help people go from credit to capital, personal business funding, partnering with Joe, getting private lending, debt consolidation. My goal to help people, now you're seeing this on the real estate investor side, is speed, right? Speed to go from credit to capital. What I'm seeing, I had a meeting with what I call up here some of the young guns that we have that are building up, and these guys are eager, man. Like, they're coming in, they're doing the work, they're looking for off-market deals. They're teaching me a lot of things, which is awesome. But a lot of these guys, my advice to people coming in, and especially this new year, there's going to be massive opportunity that I see for a lot of these first-timers coming in. And from my position and my company, from where I'm at, is my advice to them is, look, get your finances right, get your credit right, become lendable yourself. It's cool going in, partnering with deals and getting your feet wet and all that stuff. But at some point in time, I believe you're going to want that piece of the pie to yourself, right? And you're going to want to be self-sufficient, lendable in some manner. And it's also going to create other opportunities for you and your family as well down the road. So one of the things I'm seeing coming in is there's going to be a lot of people. There's a lot of people right now. We have so many people backlogged, ready to enter at least the credit side of things. To get ready to move forward. And the interesting thing is most people coming in, it's always, hey, what is your goal? What is your desired outcome out of this? Oh, well, I want to be a home buyer or I need to move, get a rent, but I really want to be a real estate investor down the road. It's like, oh, it's interesting. We can help you with that too. And then the whole dynamic kind of shifts. And there's a lot of people out there that are, obviously saying and doing are two different things, but there's a lot of people out there that are really looking to get their foothold in the door. And my advice to people now is, look, new year, I think money on a personal level is going to get tighter. Credit's going to get tighter. So fix your credit now. And a lot of things we're doing right now is getting people into debt consolidation loans, not debt structurement, not debt settlement. Most of the time you can do it on yourselves. Anyway, my opinion on that, it's a terrible idea. It's a terrible cycle to get in. But a debt consolidation loan, if you're looking to get your credit score up really quick and your credit's decent, you don't have any problems, but you're carrying a lot of consumer credit card debt. You're carrying a lot of credit utilization. Get yourself a debt consolidation loan. We've done people up into six figures, and what that does is, number one, it will cut your interest significantly, usually in half compared to where revolving trade lines are right now. Number two, cut your monthly payment down significantly, and number three, should get you out of debt out of 5 years or so, instead of paying on what most people are paying close to the minimum. It would be about 30 years. And the most important thing is when you wipe that out on the credit card utilization side, you're going to zero it out. Therefore, you're going to gain all those points back. Most people are gaining well over 100 points on that 30% side of that credit utilization, blossoming their credit score. through the roof. And the idea is, well, you just did yourself a favor to get yourself lendable now. That's my take, man. People are coming in, they're looking to buy, they're hungry, they're looking to get lendable. The Lehigh Valley, man, like we have all these awesome people that are coming. Every time I talk to somebody, they hear about this event or asking, hey, what are you posting about? Hey, look, come join, learn something, network. You want to get in. I have a feeling, Joe, this thing's going to be really special, man. And it's going to create a whole different kind of little clubhouse, no pun intended, here in the physical, man, face to face, shaking hands and making moves. Guys, that's all I got.
Dave, thank you as always. I appreciate the collaboration. And you brought up something very specific that caught my ear was speed and expedition in mastering rental investing, right? Speed is no longer optional in rental investing, right? It's a competitive advantage that directly impacts pricing, financing terms, and deal access. The investors who win are not reckless; they are prepared. So, are you seeing that more so with the younger demographic that's getting into the market?
Yeah, I mean, I think it's coming down to preparedness. And when I say speed, make it happen quick, like to get prepared, because most of this stuff, man, it's on a 30-day turnaround. So if you start dragging around or if you don't take advantage now, you're already a month behind.
Yeah.
And, but a lot of these guys, they understand. And I actually explained that to them long term. I'm like, hey, listen, if you don't fix this problem now, you're going to be minimum 6 months out. And if you let it go perpetually longer, 18 months. Take a standard residential buyer, right? Like they come in, they drag their feet. Oh, I don't know if this is for me. Like, I want to get this house, this whole process. And it's like, look, it's probably going to take you 4 to 6 months to get ready. Then you got to get pre-approved. Then you got to look around. It's probably going to take you 60 to 90 days to find something. Then you got to put an offer in. I said, that alone, you're already a year in. If you wait, you're going to be 18 months or 2 years in. So speed is just about just taking action. Yeah, strategic planning, like you guys were talking about before, have your systems in place, right? Systems are everything. And I think that's one of the things when I was with those guys yesterday, I'd say, hey, what is the system, right? Like, what are you guys structuring together to go from A to Z? And I think that's important. Like, yeah, you got to have your speed to get there, but also have very structured and systematic approach in place. And again, it just has to make sense.
Yep, I appreciate that, Dave, as always. And I appreciate, listen, we're heavily marking the Lehigh Valley event post the holiday party, which was a tremendous success. We had over 100 real estate professionals, Dave, and my holiday party, which was great. So we're going to just keep that momentum going forward. It'll be interesting to watch. There's about 4 other networking groups, 1, 2, 3, 4, yeah, 3 or 4 other networking groups that try to make a monthly attempt at having an event. I think we just kind of like fast forwarded past most of them with what we just did in the holiday party, and then just the pure follow up of we're already set with 4 subjects for the month, the whole first quarter. So if you're goal setting right now, goal set just for the quarter. Don't goal set for the year. Goal set for January, February, March, April, because it's more grabbable. You could put your arms around it, right? And I think people can they're so distracted now. So if you focus, and if something doesn't work in that first quarter, guess what? You could change it. That's what the amazing part of it all is, right? If something's not working, you fix it. Like, people are so distracted, they won't even remember something that you were focusing on 4 months from now. I can 100% guarantee that, right? Being reckless is trying to planning out 6 months or 8 months in advance. There's no way you can do that knowing how the market's shifting every quarter to quarter, especially with rates, values. We don't know what the spring market's going to show us. If anybody here knows what the spring market's going to hold for them, then they're a rocket scientist and they shouldn't even be on here, right? They're way beyond our realm of possibility. So you have to be focused by the quarter. There's no longer by the year. That's, to me, a better goal setter in mastering rental investing and understanding financing growth. Good morning, Felix. Welcome. Thank you for your patience. Brief overview, who you are, what you do, and thoughts to mastering rental investing, financing, and growth.
Grand Rising, Joe. Grand Rising, everyone. Happy New Year.
Felix Buchanan Sr., Buchanan Biz Enterprises, the JLix Group, and I'm a team leader of a Keller Williams legacy team in Baltimore County. Rental investing. First, it starts with a plan, because if you don't know what you're doing, where you're going, and how you're going to get there, then you're going to move in any direction. And that plan includes strategy, where you're getting your properties from, the financing, and whether you're using hard money lending, regular financing, business funding, family members, whatever your direction is, know how it is that you're going to be able to pay for the property to, get things started, what your rehab cost is going to be. Then you got to put together your team, your contractors, your realtors, your title companies, again, financing. What are the different aspects of how you're going to finance this? Is this a short-term rental? Is this a long-term rental? Are you going to hold it for 3 to 5 years? You're going to hold it for 5 to 7 years? You're going to hold it for a year and use it to gain bigger if you're going to go into multi-units after you start, and what that process looks like. What type of, how are you going to fill it? Are you going to use market tenants? Are you going to use voucher holder tenants, traveling nurses, Airbnb, transitional homes? What's your game plan from there, as far as how you're going to receive the income, how you're going to be able to pay the loans? How long is it going to take over the course of your plan that you only want to pay a loan on this property for X, Y, and Z amount of time, and then you're only paying taxes on it? Because part of your plan and your strategy is you don't want to hold on to this property and be paying a monthly payment on it forever, even if the loan is being serviced by the tenants that are in the property. You have to have systems, making sure that you are able to, as I think it was Dave said, speed. If you're not able to respond to these people now as fast as possible, even when you sleep, using AI, using different methods to respond to them until you can either physically talk to them, or making sure that your systems are able to answer majority of their questions, so that by the time you are actually physically able to talk to them, here's where they are within the process. So that's my knowledge and wisdom for the day. And
Felix, I got a big question for you, man. Big
Sure.
question. So non-QM lending right now is not feeling the love of Philadelphia and Baltimore. You know this, and I know this, right?
Yes, sir.
I mean, it's going to get worse before it gets better. With all the fraud cases, we're talking what, $60 million fraud in Baltimore that they supposedly caught, and supposedly $30 million fraud case in Philadelphia.
Mm-hmm.
Both cities are on the downslide.
Yes.
Okay, it is what it is, and there's nothing you could avoid about this. How are you pivoting in real estate right now? Are you advising people to kind of look outside the straight the non-QM? I mean, like, I could tell you the zip code; it's almost right off the top of my head. So, I mean, I'm just telling people, listen, you're better off awaiting more of a suburb opportunity than the cities, because they're just. I mean, I had a client, no bullshit, 75 plus door build out over the last 3 years. Great experience, great credit, new construction, and I can't find an option for the guy. Think about that. All the experience, it's all there, right? And I had 3 turndowns from 3 different underwriters on the projects itself in Philadelphia. Now, and Baltimore right now. So how are you pivoting as a real estate professional, knowing some of these urban settings are just horrendous right now? Let's just be honest.
So part of the pivot is really focusing on the traveling nurses Airbnb. So like you said, you get to go to the suburb neighborhoods, transitional housing. And then what I'm also doing is, not only am I finding the properties for them, I'm partnering with different people where I will fill the Airbnb, or I'll fill the traveling nurses for you. And which then makes it that now that they are not doing the city properties and they're going to the counties, which what does that do? That increases the purchase price, and it increases the rehab, because now these county properties, you're talking 100,000 plus. So with being able to put the traveling nurses in there, put the Airbnb clients in there, or the transitional home clients in there for them, now the property is producing income. Here's the income that it's producing, and also being able to get a percentage on the back end, because I've done all the legwork for you. All you got to do is put down this down payment, or some of them will buy the properties themselves, but I make sure that I'm able to now make
it that you're going to get a larger return on investment than you would with a regular market tenant and or even a voucher holder because of the amount of income on a monthly basis that those three transitional home traveling nurses and Airbnb bring in. So I've kind of more pivoted to a different landscape of rental clients versus just market tenants and voucher holders, which that was the space that I've been in for years. More pushing that because, you know, investors are going to move to that because of the return on investment it brings in monthly.
Yeah, some of the urban settings, and Felix and I are fully aware of this. Philadelphia, Baltimore, St. Louis, Chicago, they're having a tough time right now. Okay, from a non-QM perspective, lenders are just not liking these markets. Okay, and this will continue because of geopolitical, of affordable housing. Home ownership is just all over the map right now. So, Felix, I appreciate your your insight to and honesty about where the market's going in Baltimore because we both can you can't deny it, right? There's nothing to deny.
Can't. I mean, and what sucks is that because of the city has for so many years and there's so many, you know, times have been so fruitful, now you have a city that the properties are still here, but it's stagnant on if you're going to be able to get a loan to do that property. I mean, look at the deal that I lost.
Yeah.
You know what I mean?
We did everything we could. It wasn't like we went one way. We tried 14 different ways to Sunday. And I'm seeing the same thing in Philadelphia right now. It's just, but it's funny. I just took on a new underwriter where we are doing Baltimore, but it's definitely on refinance and purchase at 70%. Credit's got to be there. The deal's got to make sense. But on construction, it's tough.
You gotta be strict. Like you gotta be super strict with
Yeah.
your numbers. The numbers gotta be there. No type of room for error.
Yeah.
Nothing. It has to be strict.
Yep.
Everything from top to bottom.
I would 100% agree. So thank you, Felix. Happy New Year. I'm celebrating my I think almost my 20th year of knowing Felix and being friends. So been a long time. He's getting younger looking. I'm getting older looking. So it's all good. Thank you, Felix. Happy Sunday. Happy Sunday. Yeah, I mean, listen, expedition and recklessness kind of run. You know, there's inside guardrails. You got to kind of keep in consideration. You know, you got to have conservative DSCR thresholds. You got to know rehab ranges. You got to know about contingencies when it comes to rehab as well. Okay, and take rent assumptions into account or days on the market. You know, you got to look at the clear kill criteria. You got to be honest. You can't force a square peg in a round hole going into the new year. Time is a cost most investors ignore. Raising or holding costs, delaying on the cash flow, pushing refinance windows, increasing market risk. You gotta understand these pivots. Stephen, good morning and thank you for your patience. Brief overview who you are, what you do, and thoughts to mastering rental investing, financing, growth.
Hi, this is Steve, Gorilla Real Estate Broker, and also I run REI Homepage, which does a lot of other stuff, including investing consulting and education stuff. And really, the rental market, the mastering is always about the numbers, especially now. I mean, what is bad news for many people? You know, all this gloom and doom that we're going to have a reset. We probably will in terms of values. That we're going to, the 2008 bubble, whatever, is good news for those of us on the buy side if you run your numbers right. And as a colleague of mine from the Stroudsburg area, said that he woke up in 2008 and everything he owned as a rental was worth a third of what it was worth, the week before. And he's like, that didn't change my business at all. My income is still the same. My expenses are still the same. So don't be scared when or if you wake up and all of a sudden the appraisal's changed. As long as you're locked into a 30-year plan or whatever, keep paying your bills and keep moving forward. But really, it always comes down to numbers, to realizing that, and I had this on, this is the Northview one that we weren't able to find a house, a lender with you, Joe, but where it was a 1031 exchange. So I sacrificed on my numbers because it was a matter of, okay, I can't make my usual pads that I usually do. But if I don't do it, I lose on the 1031 side. So I went ahead and did it. Normally, I have a very firm, criteria, which means I buy a lot less than most other people, and it doesn't make the numbers. I move on, and that's a big part of it. The other thing when looking at the mastering always comes down to your team and really where, who and what you want to be. And as I'm going into this year where I hope to buy a lot more, okay, the where is a good question. Those cities you mentioned, I'm looking at each one of them, and I sort of have a personal preference toward Providence. And mastering has to go beyond your team. Team is important, but also what do you know about the community? Don't go buying Providence. Don't go buying, Ohio or whatever until you look at what are their rules. How do they play? How do they play their game? Very often meaning the cities. I just did a wholesale out in Garfield Heights, Ohio, and discovered that at the last, discovered fairly late in the game, they have a very stringent and unusual pre-sales inspection process, and they have that, process on an almost annual basis out there. It's a little bit odd compared to many. So really, your mastership or you has to, within your team or somebody or you has to find out what are those oddities in those markets before you buy in your $100,000 and $1 million in, and you realize something doesn't work. And one lesson I have learned, unfortunately more than once because I'm slow, is with many critical things, such as, you're in a mine area, always get subsidence insurance. Don't care what the property is, always make sure whether or not it's in a flood zone before you buy it, because flood insurance is expensive. So it really, the mastery comes from networking and talking to people and saying, hey, where have you gotten burned? What have you seen? So that you can know a market before you dive in. For instance, Providence, they're becoming, they're fairly balanced from what I'm reading. I don't know this personally, but from what I'm reading, they're fairly balanced on their landlord-tenant laws. But the city of Providence is starting to make some moves in a direction that it's going to be a little more careful because they've had some bad experiences. Okay, I'm fine with that, but just know that before you go in. If you go into buying in Massachusetts, realize getting rid of a tenant in Massachusetts is a long process. So that's kind of it, is just knowing everything you can about not just the investment and the numbers, but how the community works and what they expect and all that stuff.
Stephen, thank you. And yeah, I agree with you. 2026 is not a crash cycle. It's a disciplined reset. The market is shifting away from speculation and toward operators who understand financing, cash flow, and structure. Some things that you want to keep in mind, big picture, what's ending is more easy appreciation, blind burr math, thin DSCR deals, over leveraged short-term debt, and buy anywhere mentality. What's really beginning is cash flow certainty, financing first underwriting, midterm and needs-based rentals, professional management as underwriting, and market selectivity. I mean, these are things that you need to keep in consideration going into 26 if you're going to scale with clients or for yourself in the SFR space 1 through 4 or small balance multifamily 5+ units, maybe up to 10 units would be a safe space to consider what I'm talking about here this morning. Timothy, good morning. Welcome. Brief overview, who you are, what you do, and thoughts to mastering rental investing, financing, and growth. Long time no see.
Long time no see, Joseph, and good morning, room. Long time no see, everyone. Happy New Year to everybody. Timothy Doyle up here also in the Lehigh Valley. Dave, looking forward to networking with you at some point in time. Honestly, what every moderator has put up here has an element of truth, and there are a couple things that for those who are just beginning, welcome. Get your education. If you go out to some of these events that Joseph holds, or even your local real estate groups, you'll get to network with these people. You'll get to learn some of the topics we're speaking of, and some of the touch points we probably didn't mention, like know what your insurance rates are in those areas and what you have to cover for the particular property you're looking at. Some of the things that I usually mention are, yes, get your education, get your team. If you have a gap in what you can provide yourself as the business owner, remember, this is real estate. It's a business and can be an expensive learning lesson like owning a boat. Sorry, Joseph. Anywho, but these are great topics, Joe, and I know we've got about a minute left, so I don't want to overrun your time, sir. So again, Timothy Doyle with Buy and Hold Real Estate Investor, and it's going to be an interesting year this year. We'll see what happens. Up here in the greater Lehigh Valley, Steel Hill Properties. Remember, if you can't buy it, steal it.
Thanks, Tim. As always, look forward to seeing you in the new year here. Hopefully you'll see you at the Bethlehem Brew Works second Wednesday of this month. We're going over cost segregation. My final thoughts to mastering rental investing and financing growth strategies. Mastering rental investing isn't about chasing the perfect market rate or strategy. It's about building a repeatable system that balances cash flow, risk, and scalability over time. All your moderators touched on that, Finance is a strategy. It's not just a loan. Cash flow and appreciation. You got to balance that out. The deal decides the strategy. System scale hustle doesn't. Long-term winners think in portfolios, not properties. Again, your bottom line, rental investing mastery lives at the intersection of finance discipline plus market realism plus long-term vision. Those who respect all three don't just survive cycles; they use them to grow, and that's why we in the Creative Bird Strategy House for the past 2 years or more now, we've given as best education that we could give to the real estate professional. There's nobody here vying for street credit. Nobody's vying to take advantage of anybody. A lot of those people have come and gone, as you notice. We have very solid discussions here. I want to make sure that you know what's in front of you always. And that's what our goal is, with our website, creativebirdstrategies.com. If we could actually assist any of you in making a difference from a marketing perspective, that's our goal here. Okay. We don't have this hidden agenda. We're not a sell-a-thon house here on Clubhouse, nor on the podcast itself. I want people to feel comfortable and welcomed into the room. We have some great events coming up. We couldn't do any of this without Mr. Yordell Perkins of Perkatech, the social media architect and administrator to this entire podcast, and all the websites, all the uploads, all of it is I have to thank Yordell for this past 10 years of friendship and alignment in collaborating events. We're in Philadelphia now. We're going to be in Harrisburg. We're going to be in North Jersey. We're going to be also in Philadelphia. We're going to have a live audience podcast every second Saturday of the month at our rooftop deck office at 2nd and Chestnut. We have the podcast. We're going to be making some decisions by March 1st where we're going to be with the podcast as well. And I'm traveling quite a bit this next month. But I do want to reach out to Melissa. Melissa, please reach out to me this week when you have time. Throw me a text. But I'm very excited about what's going into the first quarter as well. Melissa?
Yeah, you bet. I will.
I appreciate that. And my quote today, which I always kind of try to come up with a unique quote, mentally strong people implies discipline over motivation, emotional control under pressure, long-term thinking versus short-term comfort, action without applause, progress without permission. That phrase resonates because it's earned, not claimed. It signals resilience, self-mastery, and quiet consistency, not hype. If you're using it as a post, caption, or brand-aligned mindset statement, it lands well for high performers, operators, investors, and builders. Everybody have a blessed week. Happy New Year to everyone. I want to thank the moderators as always. You've been great. We're going to highlight you guys on this upload coming up over the next week. And we'll see you next Sunday morning, 9 a.m. Eastern Standard Time here on Clubhouse and on the Creative Bird Strategies podcast. And I'll be ending the room in the next 30 seconds. Thank you.
Thanks, Joe. Everybody have a good week.